Okay, so I'm going to talk about something that's very different from what we saw. I'm talking about China. If you go back to the beginning of year one, okay, so two millennia ago, you start to see a shift in the world's center of economic gravity, away from Asia and the Middle East towards Europe and America, right? You can start to see that things start to change around 1950. And so what's happening around then is the rise of Japan, right? Subsequently, starting around 1980, China embarks on a series of reforms that's going to sort of revolutionize, in some sense, global economic trade. Deng Xiaoping decides that they're going to scrap all of the pure communist policies that Mao Zedong had been following for the past 30 years up until that point, and they're going to start to liberalize trade. In 1990, India does something very similar. The reasons and the settings behind that are very different, but India starts to open up its reform, open up its economy, and then in 2001, which will now should be seen as a sort of a landmark year, China joins the WTO. And so the combination of China and India entering into the world economy is what's driving this shift towards, back towards Asia. Okay? So it's if you think about the, that's strange. If you think about if you think about this type of reform in terms of free trade, if you get economists in a room, if you ask maybe Andy and Saki to debate monetary policy, you might get very different answers. That's very different when we think about free trade. Okay, so free trade, or the arguments for free trade, is something in which all economists, virtually all economists, largely believe in. All right, so you put Glenn Hubbard in a room with Paul Krugman, they're going to be at each other's necks on virtually every policy except for free trade. All right? And so we believe that free trade enables countries to specialize in their comparative advantage industries. It eliminates deadweight losses from economies. Now, in the process of this research that I'm going to explain, my co-authors, so this is also joint work with Peter Schott, who's at Yale School of Management, and Shangjin Wei, who's a colleague of ours in the Finance and Economics group. We discovered that trade can have an additional impact on economies beyond sort of thinking about eliminating the sort of deadweight losses that we typically think about that trade causes. All right, so the idea is the following: is that institutions. So when a country erects trade barriers, countries have to manage these trade barriers, right? And the people who manage those trade barriers are often bureaucrats, and the bureaucrats often have very different incentives than the firms that are paying have to pay the customs rates, right? And so if trade barriers are captured by a bureaucratic institution, then free trade can provide an additional gain by eliminating these types of misallocating institutions. That is, trade reform is going to remove the standard deadweight losses from an economy, as well as embed institutional reforms. All right, so let me put this in the context of China in particular, because that's going to be the setting in which we analyze this. So if you look at China over the past 30 years, what you've been seeing is a slow dismantling of the power of the state-owned enterprises. Right? So state-owned enterprises are these very large behemoths, which are very, very inefficient in terms of how they deploy resources into actual outputs. Something changed sort of around 2005, in which you start to see this sharp decline in the importance of SOEs in terms of the share of overall assets in the economy. If anything, the trend is slowing and often flat. The importance of them in terms of size is growing even more. All right, and so this raises the question of resource allocation and to what extent resources are being efficiently allocated within an economy. All right, so think about an economy with just two types of firms, or two firms in general. So the two firms are completely identical, and the only difference is that one firm has a political connection and one firm does not. Okay? And the firm that has the political connection can benefit from subsidized credit. Okay? And that subsidized credit may come from the form of a state-owned bank, which happens in China. Okay? The other firm does not have that political connection. It's equally productive, but it has to borrow at higher interest rates, often from informal financial markets. Okay, so what's going to happen in this world is that the firm with the political connection is going to have more capital, okay, because it can borrow cheaper, right? But what that means is that once that firm has more capital, any additional unit of capital that you give to that politically connected firm is going to have a much lower effect on the economy than if you gave that additional unit of capital to the less politically connected firm, right? In this situation, resources are not being allocated to the most productive use. To get a sense of what that looks like within China, I'm going to show you a picture of productivity in China across firms, all right? And I'm going to compare that to the United States. So if you look at the United States, you get this sort of standard bell-shaped curve. So you get firms who are at the average levels of productivity, and there's some firms above and some firms below. There's not so many very exceptionally productive firms, and there's not so many exceptionally unproductive firms. Now, compare this figure with the one above, and you see something that's very striking. What you see is that the variation in productivity in a country like China, and so this, by the way, is also, you get similar pictures from many other emerging markets, the variation in productivity is much larger, right? So there's something happening, or not happening in the case of China, in which relatively unproductive firms who, if they existed in the United States, would be kicked out of the market. Market forces would drive these firms out of business, is causing these firms to remain in, continue to operate in a country like China, right? And by one sort of well-known estimate, China's productivity would actually increase by as much as 40% if you just take the existing stock of capital in China and you moved it around to offer it to the firms who would have the highest productive use of that capital. Okay? But this raises a really, really challenging question, which is how does a country like China reduce the power of entrenched firms? Okay, so think about what's happening here. Is you have members of the Communist Party who have uncles, brothers, and sons who have who are extending credit to those firms which have those connections. And you can imagine it's very difficult to reduce the power of those firms. Right? So how do you actually cause institutions to reform when firms are entrenched? Right? And so the idea that we hit upon was that trade reforms can actually bring this about. Essentially what a trade reform or an external trade commitment would do, this would be in the context of signing an agreement in the World Trade Organization, is it ties politicians' hands. Right? So the politician now has to say is, he goes back to his uncle and says, look, we have to shut you down. We can't continue to offer subsidized credit because we have this commitment we've made in the WTO. And there's a lot of people who are vested in that WTO commitment. And so I'm sorry, we're going to have to break you up. Right? So it's the power of external reforms or external trade commitments which can dismantle misallocating institutions. Okay, so what I've just talked about is something that's very abstract. And so the question is, how does one try to study this particular idea? So we're going to use a very particular setting in the context of China to examine institutional reforms. And the setting is the apparel industry right before and right after global quotas ended as a result of the World Trade Organization. Okay, so up until 2005, basically from the 1950s onward, the United States, Europe, and Canada imposed quotas on apparel and textiles. Okay, so if you're a Japanese firm in the 1950s, the firms down in North Carolina successfully lobbied for quotas because they were worried about their jobs. Right? And so originally, we told the Japanese that only 100 units of trousers can land on our shores. The Japanese economy grew. They are no longer producing textiles and apparels. They're producing much more high-end goods. And so by the time we get to 2005, the major country that's being constrained by these sets of quotas is China. Okay? China's at a much earlier stage of development. Okay. So here's what a quota would look like. So this comes from the United States. So each country, so the EU, Canada, and the United States, were able to allocate the quotas on the particular products that they wish to do. So the US is not very big in silk production. Okay, so we didn't tend to protect silk. The Italians tend to do much more silk, and so the Italians tended to protect much more silk. Okay, so each country imposed quotas, but they got to allocate the quotas however they chose to fix it. So in the case of the United States, we put quotas on women's cotton shirts and blouses. The quotas would tell us how much we could actually import from all the countries in the world. Right, that's all I want to say. All right, so think about quota-bounded goods. So these would be textile and apparel products that were subject to quotas up until 2004. So men's cotton pajamas that were sent to the United States and Canada, those are subject to quotas. The EU, for whatever reason, decided that they were not going to protect those particular products. So men's cotton pajamas that were sent from China to the EU were not subject to quotas. Right? And the quotas ended in 2005. January 1st, 2005, the WTO gets rid of all the quotas. All right. Now, what you see once the quotas are removed is something that you should expect, which is these are exports from China for goods that were not subject to quotas. Okay, so this would be the cotton pajamas that are being sent to the EU, not subject to a quota. And these would be the cotton pajamas that are being sent to the US and Canada. And what you see is that there's a strong, just a standard linear upward sloping graph, a trend of exports coming out of China. But you see this turn on a dime in 2005. Right? The quotas are removed, China just takes over the world. Okay, so the question that we want to answer or to look at is how the Chinese government decided who was going to export under the quotas and who was not. So every country, Hong Kong, Japan, Indonesia, India, Bangladesh, Pakistan, all of these countries had to decide how they were going to allocate the licenses or the opportunity to export textile and apparel goods. We actually don't know precisely how the Chinese did this, okay? But we can infer from the data the mechanism through which they allocated. All right? So you just need to have sort of one piece of economic theory in the back of your mind to understand how this process would work. So imagine the Chinese government decided to set up an auction. Okay? So if you set up an auction, this is how we would think would be the most efficient way to allocate this resource. It's a scarce resource. People bid. The people who value it the most are going to bid the most. The ones who are going to value it the most are going to be the ones who are most productive. Okay? So the most productive firms are going to bid. And once those quotas are removed, those firms who had bid on those quotas prior under the auction would expand. Okay? We can think of an alternative mechanism in which the government allocated for political reasons. Right? Under these reasons, it may or may not be the case that the efficient firms would get it. Okay? So maybe the inefficient uncle, who's not very good at producing apparel, has strong ties to the institution that was designed to allocate this, which is MOFCOM, the Ministry of Commerce. All right? So what that would mean is, though, once the quotas were removed, you would get this massive reallocation within China away from inefficient firms towards efficient firms. Right? If we see that, that's evidence that the original allocation was not efficient to begin with. All right? So it's the source of the growth. Is the growth coming from incumbent firms, incumbent efficient firms, or is it coming from more efficient entrants, which is going to be the key to determine the relative efficiency of the allocating institution in China? All right? Okay. All right, so the way that we're going to use, the way that we can examine this is that we can use customs data from China. So customs data are very detailed. They have, for every firm in China that exports, you know the particular product that they export, you know which country it's going to, you know the year, and you know the values and the quantities. All right? We'll focus on these particular textile and apparel products that are being exported from China to these three developed regions. In China, we also observe one more thing about these firms. We know if the firms are state-owned, whether they're domestically owned, so these are private domestic firms, or if they're foreign firms. All right? And we can use just a very simple comparison between exports from products that were quota bounded relative to products that were not subject to quotas as a treatment and control, and attribute any differential response between these two groups to the removal of quotas itself, as opposed to other reasons going on. OK, so here's just a very brief, here's just one very clear way to see that the allocation was inefficient. So I'm going to look at the market shares in these products. So these are all relative to the control group. And I'm going to look at them prior to the change in market shares from one period to the next, so pre-quota, post-quota. So market shares always add up to 1. So any market share that goes to one firm is going to have to come at the expense of the other firm. Okay? But what you can see here is that the incumbents lose a large portion of their market share, and it, by definition, has to go to the entrants. Okay? But what you notice is if you look at these 3 types of firms, you see this big decline in the state-owned firms. Okay? So state-owned firms lose a large portion of their market share, and that market share is eaten up by net entrants who are privately owned. It's a transfer of resources going away from inefficient firms, the state-owned firms, to the more efficient firms, which is very strong evidence that prior to the, under the quota regime, the Chinese government had allocated in a way that was not what we would think as being the most efficient way. All right. So here's just a very brief way to picture the relative productivity of firms. Okay, so the solid line is the state-owned firms, and the dotted lines are the private firms. And the only thing that you want to take away from here is this big leftward shift in the productivity of state-owned firms. State-owned firms, on average, in this particular sector, are almost 80% less productive than private sector entrants. Right? But they receive the majority of quota licenses under the regime. Okay, so this is very strong evidence for us that the quota allocation was inefficient. So then the question is, can we quantify how large the gains from trade would be if the government had actually followed an auction allocation versus this actual political allocation that we observe in the data? Right? And our claim is that the gains are going to be much larger if the quotas were actually misallocated. All right? So imagine, so what we have to do is we have to construct a scenario that we don't actually observe. We have to construct a counterfactual scenario in which the government uses an auction to allocate the licenses, and then examine what would have been the gains from eliminating the quotas. That's not the world that we think we live in, and so we need a model to simulate that counterfactual auction. And we can compare that to the data, which provides us a very good sense of what we think the actual allocation look like in order to examine how much larger the gains from trade are. Okay, so here's how such a process could work. Okay, so you can ignore the black line is just going to, so what I've done here is I've just taken a set of hypothetical firms and ordered them on their productivity. So the actual numbers don't matter. Just think of these guys as being really productive and these guys as being really unproductive. And over here is their market share. Okay, so the black curve would give us the theoretical market share of firms when there's no quota at all. So this is just whoever is the most efficient firm is going to have the highest market share. Okay, so that's why that curve is upward sloping. Under an auction, we would get something similar. The auction, the most efficient firms would bid for the most licenses, and they would have the highest market share as well. Okay, so again, under the auction, which is this red curve, you're going to get an upward sloping line. Now, what we're going to do is simulate a political allocation. Now, what that means is that we're going to examine how correlated is a firm's underlying efficiency with their political connections. Right? If they're perfectly correlated, so if the most efficient firm is also the most politically connected, then the political allocation would match the auction allocation. Right? But if we break that correlation, you start to see something slightly different. So this is saying that the political allocation is not perfectly correlated to the auction allocation. There are some firms, this guy in particular, or this guy here, who's not so productive, that gets a really high market share. Why? This is telling us that this is a firm that looks like a state-owned enterprise. It's not very productive, but it has a high market share. And the reason it has a high market share is because of its political connection. If they actually had to bid competitively, they'd have a much lower market share. Okay? And so you can just simulate this. Right? And so for example, this is a very weak correlation between political connections and firm efficiency. So what this is saying is that the most efficient firm is not able to get a license. Very inefficient firms are able to get licenses. So these are the even bigger and weaker weaker in terms of efficiency state-owned firms, but have stronger political connections. We believe that our data looks something like this. It's basically, there's a very weak correlation between the efficient firms in this particular sector and those who have the political connections. So again, this is the state-owned firm, high market share, unproductive. All right? And you can actually go through this. So this is this would be the worst case scenario, we think, right? So this is the worst case scenario in which the Chinese government knows exactly the relative productivity of everyone and just give the licenses to the worst firms, right? So you get a perfect inverse correlation. We don't think we're in that particular world. Okay. So the takeaways is two things. So one is, so obviously China has benefited substantially from the removal of quotas and the removal in general of trade barriers around the world. But a lot of the gains, when we think about trade reforms, we tend to think about lowering tariffs. This is not, our research suggests that this is not the full story behind really the growth in China. What really is the important part of this story is that as China has had to open up, they've had to implement market-based reforms. They've had to dismantle the power of the state. And a large portion of the gain from trade is coming from just changing how resources are being allocated. So trade is embedding in institutional reform, right? And it gives us this research sort of illustrates the power that external trade reforms can have on reforming institutions that have been captured by corruption and political connections. And so there is a very strong role for the WTO to continue to enforce countries' commitments. For example, energy policy. The Chinese subsidize a lot of energy policy. It's not going, again, to the most efficient firms. Suntech, some of you may know about Suntech, which was a very large solar panel company in China, which had a large amount of subsidies from the state, recently went bankrupt. And so the question arises then if the WTO could enforce or eliminate those export subsidies, which it has in principle the power to do, whether that would further improve the efficiency of resource allocation within a country like China.